Hello, everyone. Welcome to today's Facebook Live. All right, so today we want to talk about something that is so relevant to what we talked about last week. Last week, we talked about passive versus non-passive income. We kind of mentioned rental properties as a passive activity by default, but that there are other ways and there are some loopholes that we can use to convert a rental property for our benefit if we need a passive loss that offsets our income, or if we need this, we don't have that much time to put it into an activity to generate us a loss because we have our W-2 income, we have our full-time job, we have a lot of other things that we do, we manage our businesses. So we don't have much time, but there's that short-term rental loophole that we kind of touched on. And we said that it's only one strategy that we use as non-passive income that can offset our non-passive. Of course, it could be income or loss, but our purpose is to generate the losses that can offset our non-passive and activity income coming from our W-2 and so on. All right. Again, this is just one strategy, but there is a lot of other things and a lot of other passive businesses and passive investments that you can get in that can generate you losses that can offset your W-2 income in some way. And we can plan it and strategize it in a way that doesn't have you to put too much too much time, in it, but it still gives you this non-passive status, even though it is really passive. How and when and so on, we kind of touched on that last week. But today, I got a new client that I was looking at their tax returns for that was prepared by another accountant for prior years. And I found this mistake of reporting the rental activity. And that's why it came to my mind, oh, maybe we need to talk about this. If you have a rental activity, where would you report it on your W-2? Of course, most of you wouldn't know like where it would be reported on your tax return. So you kind of give all your stuff to the tax accountant and you expect them to do the right thing and the right reporting. But it's a common mistake, and I want to tell you about it today so that when you review your tax return, you know if it was done right or if it was done wrong. At least you can ask a question and find out if it was done properly so you don't set yourself up for audits or for flags. All right, so again, let's dive in. I'll share my screen and I'll tell you exactly what I'm talking about. All right, so yeah, as you know, I like to start with a joke to lighten up the tax mode that we're talking about. So here we go, and we want to start. So this is the best way to teach your kids. Just eat about 30% of their ice cream and you would get it. You would understand. All right. So Schedule E versus Schedule C. If you have a rental property, you want to report your rental income the right way. So where would you report it? Schedule E or Schedule C? And if you have been seeing my videos, you probably know the answer to this, but let's focus on this today. The basics. What's a Schedule E? A Schedule E, it's used for most rental property income. Most rental property income, meaning that there is some rental property that can be recorded on Schedule C. Passive income by default. Think like long-term rental, mainly that's where it would go there. Report rents, expenses, depreciation related to your rental property. Net income on Schedule E is not subject to self-employment taxes, the 15.3% that you pay on your net income if it's a business or if you are if you're having a Schedule C income. All right, so that's the basics. We need to keep that in mind. This is how Schedule E look like. Let me see if I can, yeah, let's zoom in and see. So Schedule E, this is where you usually would put the like the property address and what type of property it is. And these are the type of properties that are defaulted by the IRS, whether it's a single family, vacational, short-term rental, multifamily, commercial, land, royalty, self-rental, or other. And of course, you can have multiple pages of this, depend on like how many properties you have. And for each property, you list the rental income you got and all your expenses, including depreciation. This is where we hope to get all our losses from. And the total comes here. They combine everything here and it comes here. And as we said last time, passive losses offset passive income. All right. And whatever net here, if it's a net income, if it's a net profit, you do not pay self-employment taxes on. Okay. All right. So that's for Schedule E. And this is on the first part of Schedule E because there is another part for pass-through entities that we're not talking about today. Then let's switch to Schedule C. What's a Schedule C? You use for active business. This is an active trade or business where you participate in, materially participate in. This is where you record a Schedule C. It applies if you're providing substantial services. So if you have an Airbnb, if you have your property, you're renting it on Airbnb, but you provide daily cleaning, you provide meals, then it's considered substantial services that it's no longer rental passive activity, it's more of a trade or a business that's very active. In this case, the net income would be subject to self-employment taxes, 15.3%. And when you want to make a distinction, think like running a hotel. Do you rent your property and you just check out with the guests when they check out? Or you keep it checking on them? You change their sheets, you change their garbage, you give them meals, you do kind of everyday activity while they're there enjoying the rental. If that's what you're doing, this is more of a substantial service. It's like running a hotel. Then in this case, it would be considered a Schedule C. But if you're not, then it's a Schedule E. So Schedule C, it's a profit or loss from business, as you can see here. And here you would require what type of business is it. You would say that this is for rental real estate, and you would report the income here, expenses here, and also include depreciation here. But the net income, if you are at a net profit, you get to pay the self-employment taxes on. So now I guess you have an idea of why the distinction makes a difference. Let's go side by side just quickly. Schedule E versus Schedule C. The type of income we said rental, if it's a passive, then goes on Schedule E. In some cases, like the short-term rental loophole, you can put it on a Schedule E as long as it's less than 7 days average rental, and it wouldn't be subject to self-employment taxes. So that's the only way. Schedule C, you put it, of course, it's a business and it's active type of income. Schedule E is not subject to self-employment, Schedule C does. So here, when you see the differences, that's what you need to keep an eye on, if it's hurting you or if it's not done properly. Depreciation allowed on both, so we don't care. Material participation, it is required if for both if you're selecting a non-passive status. And when Schedule E, you need to look at the grouping, because you may elect that you group all your real estate activities as one. And in this case, the material participation would be required for any one of them for you to have them all treated as one activity that's non-passive. All right, short-term rentals, we said maybe on Schedule E that it would be a non-passive activity, or Schedule C likely applies. You put the short-term rentals, most of the time you put it there if you provide a substantial services. Schedule E has a very low audit risk compared to Schedule C. So that's another thing. If you have a rental property, you don't provide substantial services, even if it's short term, and if it's on a Schedule C, you're setting yourself up for audit risk that's not totally necessary. So keep in mind that factor. All right. So when does rental go on a Schedule C? We kind of said it already. So if it's average stay less than 7 days with substantial services, think like running a hotel. Less than 30 days with substantial services, you're operating a business. You're not just collecting rent. So you're not just talking about managing tenants or choosing between them. And once they're there, okay, everything is good unless there's a disaster and they have to call you. But no, we're talking again about major and substantial services. So examples like Airbnb, vacation rentals with concierge, daily housekeeping, meal preparation, things like that. So that's when it goes on Schedule C. But again, we said that even the less than 7 days, if you're not providing substantial services, can go on Schedule E since it wouldn't be subject to self-employment taxes. Consequences of filing wrong, and that's when I told you that it just came to my mind when I was looking at this client, the new client tax returns from prior years, that it's a huge red flag. It's not done properly. He had rental property that he's renting less than 30 days or on average 30 days, and it wasn't he's not providing any substantial services, and it was recorded on a Schedule C. For him, it was at a loss, so this losses was helping him to offset his W-2 income. So he was paying less taxes, but that's not right. He was doing it in a way that's not really legal. So he's setting himself up for audit risk. And if they come and they audit it, there is a risk of penalties and interest. They would reclassify it. So you have to pay back that money, because if it was on a Schedule E, in this case, he wouldn't have been allowed these losses because it was not a passive, it was not considered a non-passive activity. In other people's situation, it is different, because if they had it as if he's at a rental, if he's at a net profit in 1 year, then it's recorded on Schedule C, he would be subject to self-employment taxes. But why? It's not up to the standards that he has to record it on a Schedule C. So proper filing is very, very important in this case. And also keep in mind that you can lose the QBI deduction if the IRS come back and say, okay, we need to reclassify this from here to there, especially from Schedule C to Schedule E, and you're not up to the material participation part and it's considered passive, then you lose your QBI deduction if they did this reclassification, which triggers more risks and more penalties and more interest. So that's the way, that's the dangers of the improper classification of this. So I don't care if you had to pay less taxes, but you paid less taxes the wrong way. That's not right. I want to help you pay less taxes, but by planning it in the right way. So my goal is to work with you to help you pay less taxes, but by the proper classification, by doing it right, and by seeing, okay, you have this activity, let's combine it with another activity. If it's a passive income, let's combine it with passive losses. If it's a non-passive income, let's combine it with non-passive losses. And from there, we can reach to the goal that we want. We do things right without generating any risks of audit or penalties or interest, and at the same time, pay the least amount of taxes in a legal way. So if you're not sure if your rental properties were done properly, were recorded properly, or were reported the right way, and if you need to strategize your taxes to pay less on taxes, if you have that pain of paying too much, please reach out. We'll help you take a look at everything and plan your taxes the right way so you're not at risk of audit and you're saving taxes on taxes. All right. Thank you, everyone, and see you next week.